very similar dichotomy taking place. We have the regulators in the guise of Dodd-Frank pushing technology, whether it's CEFs or whether it's electronic trading and other instruments, on the industry. Now, it's hard to predict, do things track exactly over time, who's to say, but I think you can put some stock in what you've learned from history. So my suspicion is over the next 8 to 10 years, there will be an enormous business opportunity / disruptive force in some of the businesses that have yet to be touched by technology. Fixed income trading certainly has been touched by it, but I think it'll be touched by it a great deal more. A lot of the listed derivative products and many of the very liquid over-the-counter derivative products will be impacted by technology. Will that break up some of the strangleholds certain organizations have? For example, I believe, and you guys do it more than I do it, but I think there are maybe 5 or 6 dealers that kind of control the CDS market. Will that change? I think there are 8 or 9 dealers that have over-influence on the swaps market. Will that change? My guess is it will. So when technology is linked to regulatory fiat, expect, if not a revolutionary, certainly an evolutionary change in a relatively brief period of time as to how the markets operate.
Yeah, and I guess, Josh, you referred earlier to some of the challenges of illiquidity sometimes in the fixed income products. I don't know, Josh or Carey, if you've got a view as to whether the electronification of some of the fixed income products might be part of the solution to that. I know that's kind of a hot topic debated within banks. Do you have a view on that, Carey?
I completely agree with Tom in that, I think there are going to be, and it's hard when I think about credit markets, there are certain parts of the market that I think through evolution you would see become more electronic. And I think Josh made this point earlier. The challenge is that, not all, when you look at equities or FX markets or even rates markets, you have much fewer instruments. There's one Citigroup stock. There are thousands of Citigroup bonds, and they could all have their own personality. If, 1 or 2 very large asset managers own all the bonds, they become very, very technical. So those are things that I think, if left to its own devices, like I said, you'll see evolution. Things like the credit indices, for example, are very, very liquid in the sense are already trading via, like an exchange right now. But I think technology is going to make a dramatic change in the business, and it's one of the things that, from my seat, worries me the most. I kind of feel like, and ironically, it's less when I look to my right and left, the traditional competitors we deal with, they're probably less the people I'm worried about. It's more like Tom, who doesn't have that legacy business that he's trying to defend, who's going to come in with that disruptive technology and, replace what, today are, the 5 to 10 very large banks or brokers that, dominate a lot of the credit trading activity.
From your lips to God's ears. One thing we do need to keep in mind when Josh has pointed out the illiquidity in some of the market segments, we can do a lot of bragging, and we have, about how the equity markets have become more electronic, but not the entire spectrum of equity markets. When you look at the equity markets, there are roughly 19,000 publicly traded companies in the U.S. About 6,000 to 7,000 of them are robust enough to qualify for listings on exchanges, whether they're the New York Stock Exchange, NASDAQ, or maybe some of the secondary and tertiary ones. That leaves about 12,000 or 13,000 companies that do not trade on an exchange. And that gets into the small cap and all the way down the illiquid spectrum into the micro cap names. We still have not had an opportunity, we haven't figured out a way to automate the trading of those names. Another interesting data point over the last 10 years, when I started at Knight Capital Group, we had 260 market makers, mostly men, sitting in a large trading room clicking away on keyboards. We had 5 quants. And literally, it was 260 people trying to make markets in a decimal world, and we had 5 folks writing programs as to how to trade more efficiently. Today, we have 40 market makers, and we have 150 quants. That's the kind of dynamic. Having said that, the 40 market makers are there trading the 12,000 names that haven't been able to be put on a screen. So there'll certainly be change in the fixed income markets, but I'm not here to tell you that I think every fixed income product will trade electronically. They can't. But certainly there'll be change, but there still will be these issues of very illiquid names that will need dealers to pay attention to them.
I want to turn to another topic that's been a hot topic in the discussion about Wall Street businesses the last couple of years, and that's really, I want to touch on the securitization markets. Clearly, before the global financial crisis, the CLO market was a big driver of liquidity in the leveraged loan market, and I think, as Josh and Bennett probably know well, as Carey's team probably focuses on, CLO formation, while it's come back a little bit recently, is still down quite a bit from where it was a couple of years ago. And that was an important source of liquidity for corporates, for private equity firms. I guess, Bennett, I wanted to get your perspective on where is the liquidity going to come from in a securitization business that really isn't there anymore? Is there another place where that can come from?
Well, one, I think that securitization market is coming back fast and furious. You go back through the financial crisis, the CLO technology actually worked. The efficacy of these structures when you have a bunch of downgrades change the waterfalls and all the cash gets diverted to the AAA tranche. And anybody who held on actually did fine. So we're starting to see in this quarter a big pickup in CLO formation. 70% of a CLO liability structure is the AAA tranche. In today's world, prices at about L plus 125 to 130. If you took a single A rated corporate, IBM, on a swap equivalent basis, that's about L plus 30. And you have all that risk, that idiosyncratic risk of one name versus a pool of 100 different names where no more than a 1% concentration. And if you do have a problem, at least you're secured.
Yeah.
One of the great things that investment grade buyers forget about is if there is a problem, a fallen angel goes from a triple B down to a single B in defaults. The unsecured debt tends to have a very bad outcome in a bankruptcy. So I do think the CLOs will come back. In 2007, I think they peaked at $100 billion in new issue product. This year, we would anticipate 15 to 20 billion of new CLOs, just based on the strength of the first quarter. So it's down 80%. But I think the 100 billion was probably a big aberration. There are a lot of institutions, though, tuning into this leveraged loan market. Today, the typical single B loan trades at about L plus 575. The historical norm over the last 25 years is probably closer to L plus 450. It's one of the few segments of the capital markets where you have a security trading well below its historical norms, and we're big believers in the regression to the mean. So at some point, that L plus 575 ought to migrate to L plus 450, the way it has in every other public market, around the world. So we're seeing pension plans, insurance companies, all starting to tune into this asset class. You may say 6.25 doesn't sound very exciting for a return, but if you're a pension plan, 6.25 might be like the old 10%. And if you go back over 25 years, loans had one losing year, just one, which was 2008, and they essentially recovered 6 months thereafter, June, July of 2009. So there's a lot of investment merit. Loans seem cheap. We not only see a lot of institutional demand around the world, but we're starting to see a lot more retail demand. So these mutual funds that offer portfolios, diversified portfolios of leveraged loans, have attracted a lot of capital. So we actually believe there'll be much more flow coming into this asset class, and while CLOs may not be as big as they were, there are many other alternative forms of capital formation all at work as we speak. So we would expect that market to grow pretty meaningfully.
Josh, do you agree with that?
Yeah, I agree with that generally. A couple of small points I'd add, and I think Bennett obviously has terrific command of this area. We printed a CLO in the early 2000s. The AAAs were L plus 50 or 55 or something. Compare that to that 125 today. And those things haven't, and there was a time there in the mid-2000s when I think CLOs provided something like 62% of all of the bank lending consumption.
Yep.
And so clearly when the cost of the AAAs goes up, where the number of CLOs decreases, that has an impact on the cost of borrowing to companies. When European banks are looking at a lot of bilateral loans that they really don't want to roll over because of the capital costs, you have, that will have an impact on the cost of borrowing to borrowers. But I think that irrespective of any regulatory issues, that widening of price tends to attract capital, as Bennett points out, and it comes in a lot of different forms. And whether it's hedge funds and other financial alternatives shops, whether it's bank debt funds or whatever, interceding and buying paper, the risk-return proposition from the investor's point of view starts to get awfully attractive. The only cautionary issue I would mention on that spread statistic is the LIBOR is awfully darn low right now. Sure. So on an absolute compensation for loss basis, your L plus whatever today versus L plus a little bit less a year ago might be an absolute lower number by quite a material amount. So you have to be a little bit cautious about that as well.
Yeah, it goes back to those liability streams a lot of the pension funds and insurance companies have. It's one of the few assets that gives them a chance of earning something close to what they've probably built in as the discount rate in those. I want to go back to an audience polling question. There's a lot that we could cover in regulatory, and I guess the way I'd like to do that is to just get some of the views from the audience and let some of our crew up here comment on them. And I guess just a note to the folks in the back, what I want to do is roll through both the regulatory questions and then we'll roll into some of the questions on market views, because I think in some respects we can do the two of those together. So we'll have a bunch of questions here starting with this one. So in your opinion, how in sync are regulatory bodies and proposed regulations with some of the industry market realities? We've got a more than 90% financial audience, so I'm going to guess we'll get some pretty well-informed views on this. Very, somewhat, not very, or don't know. So go ahead and give your views on that. And when we have that, please show that on the screen. So not very, overwhelming. So yes, definitely a high concentration of financial services folks. So let's see how on top of the details people are. So there have been 222 Dodd-Frank rulemaking deadlines that have passed. And how many of those, what percentage of those 222 deadlines were actually met with the finalized rules? This isn't proposed rules, because a lot of these, as people know, the rules get proposed and then there's a comment period before they're finalized. So is that more than 75%, 50 to 75%, 25 to 50%, or less than 25%? And again, these are compared to the deadlines that were set, so go ahead and give your best guess on that. And please show us the answer as you have it in the back. So people guessed D, 81%. Maybe we're leading the audience a little bit. The correct answer is C. It's about 30%. Only 67 of the 222 rules as of the end of March have actually been passed. I thank the congressman. I think that data came from him. Then the next question. Which post-crisis regulatory changes will have the most meaningful impact on Wall Street 5 to 10 years from now? So are those the new liquidity rules? Recall we said that there's $4 trillion in new financing the banks would have to do under B3. That's just the major banks. B, the Volcker rule, which has been referred to a few times. Some of the too big to fail regulation, which is C. D, a financial transaction tax. Or E, the increased capital requirements. Go ahead and give your answer on that. And when we have them, let's show the results there. Increased capital requirements. Again, maybe we sort of led the audience on that one. I've got and I don't know, Carey, if you'd agree that that's probably the biggest impact. I think that and funding are probably the two.
I agree.
Yeah. So I guess before we have the panelists comment on this, with this many marketeers up here, I also wanted to be sure that we got some of their views on their outlook for the markets. But I want to first poll the audience so that we've got some context. So if we could go ahead with our next audience question, which is just a question on where will the S&P finish in 2012? We've tried to pick ranges that are tight enough that folks have to more or less make a decision. Let's see how bullish the audience will be. Is that A, less than 1325? is that B, 1326 to 1375, C, 1376 to 1450. That's the range in which I believe we closed last night. Or D, greater than 14